Well, hello everyone, and welcome to the Worth and Wealth seminars. My name is Jennifer Duran. I'm a program associate here at the Office of Economic Empowerment. And today, our topic is investing for beginners. Before we start, I do want to remind everyone that this webinar is being recorded. For a little bit more information about our disclaimer, please check the chat. Also want to remind everyone that all materials, including the slides, the recording, some supporting documents, and additional resources will be sent out via email by the end of this week to everyone that registered. So if you're here, you'll receive it, but if you just registered for any of our webinars, you'll receive that information as well. And without further ado, I'd like to introduce Amanda Morales, who is a financial advisor, investment manager, and founder of the Wealth in 360, where she helps or empowers people through financial education and financial coaching. I'll let her speak more about herself, but without further ado, Amanda, thank you.
Thank you, Jennifer, and good afternoon to everyone that took the time to join. And I want to thank for being here this afternoon to talk about such an important topic, which is investing. So I'm going to share my screen so we can get started. Investing for beginners. So this is a nice follow-up from the previous webinars that we've had. In the last few weeks when we talked about generational wealth, and then we talked about budgeting, and we talked about smart ways of savings, and then we're talking about investing and how do we take our savings and our wealth building to the next level. I do want to start by disclaiming some points that today's information is educational only. It is not intended to provide financial investment, legal, or tax advice. And all of these scenarios that I will be sharing this afternoon are hypothetical and only for illustration purposes. Um, your financial situation is unique to you, so please consult a qualified financial professional before making any decisions or any final financial decisions. A little bit about me, for those that are new to our webinars. Samantha Morales, as Jennifer mentioned, I'm a registered investment advisor, financial coach, and I've been in the financial service industry for over 20 years, working in mutual fund um, pricing and valuation, but also working with investment accounts. I'm a founder of the Wealth in 360, which is a firm that empowers individuals to build wealth, and also grow their money to a level where they feel financially independent and free. I'm also the co-founder of Aura Inc., which is a non-for-profit that is dedicated to providing financial literacy and empowerment to low-income individuals. I'm also the chair of the Board of Trustees of Salem State University, and the reason why I'm so proud to say that is because as a board member, I have the opportunity and the honor to have a small impact into our next generation, which are the students that attend the university. And my mission is to empower all to achieve clarity, confidence, and the control over their finances. And on a personal note, I enjoy walking the beach, learning something new every day, and exploring new places with my husband and kids, things like restaurants, different cities, museum. And I wanted to put a picture here of my happy place. This is a beach in the Dominican Republic. It was 85 degrees, sunny, and I really enjoyed the beach and the warm breeze. So before I get started, I would love to hear from those that are here. What's your favorite place? Do you like the mountains? Do you enjoy the beach, or do you like the city? What would you consider that place that brings you happiness? So I would love to hear from you. So if you can drop those answers in the chat, and then Jennifer can keep track of those, and then you can share with us what have guests share. Jennifer, which one is yours? How about you? Do you want to get us started?
Oh, I definitely can start us off. One of my happy places is Aruba. I went there with the
Nice.
family, so it was a really nice trip. Um, and I love the DR weather as well.
Yeah,
Someone said horseback riding, golf courses, mountain, Costa Rica, beach, hiking, music, quietness, which is nice, mountains,
nice.
also the DR. So we have a lot of variation here.
Awesome, awesome. Well, think about that happy place as we are talking about investing, and please add any comments or any questions that you have throughout the presentation, and Jennifer will keep track of those in our chat. I definitely want to address any questions that you'll have, and I want to clarify any points that I presented. Like I want everyone to walk away from today's presentation understanding how to invest or how to get started with investing, and also feeling more confident of how to take the next step. Um, all right, so one question is, what do you think about investing? What comes to mind? A, growing my wealth over time. When I think about investing, I think about B, risk and losing money. Or I think about something complicated or confusing. Or D, building financial freedom for my future. So what are those things that come to mind when you think about investing? So what's the common thread? And I think, I could have added something at the end, all of the above, because it could be also a combination of all those. So it's a completely normal feeling when it's something that we're doing for the first time.
Yes, totally. I see a combination of AC and A and B, a few C's. We have a D in there, and a combination of DNA. Looks like
Okay,
A being our most popular answer here.
so great. Thank you for all of everyone that answered. So uh, hopefully through our presentation, you'll be able to understand the B, which is risk versus losing money. What does that mean? What kind of risk can I take? And then also for those that answer C, my goal is to simplify it and make it less confusing. So you feel more confident to take the next step in your financial journey. So before, let's just understand what investing is. And investing means putting your money to work to make more money. And the purpose of investing is to grow wealth. Um, it also to beat inflation, and we'll talk about what that means a little bit more throughout the presentation. And it also helps you achieve long-term financial goals. And it works by investing in things that have value, that grow in value, such as stocks, bonds, things like gold, and other assets that accrue in value over time. Assets are meant to give you profits and or increase in value. And the reason why I included and or increase in value is because you may have assets depreciate in value over time. So as we think about investing, we definitely want to have a mindset of how do I invest in things that grow in value over time. When you invest, it works by you when you earn money. You don't earn money only in the investments that you've put in originally, you also gain on the gains of the original investment. And again, we'll continue to talk about that through the presentation. But that third one is key here because your revenue and your value continues to compound over time. And the longer you let your investment sit in an investment account, the more it's going to compound over time, and the larger your dollar amount is going to increase as the years go by. So before we go to invest, I want you to think about the previous webinars that we've had, where understanding what's your income, understanding where your expenses go, understanding what's your debt, and what's the plan to reduce debt, and then understanding what your goals are. for either retirement, either I just want to earn some additional income via dividends or interest, um, or I want to invest in big purchases such as buying a home, or I want to pay for my education or other milestones that you may have in your life. So again, there's a understanding what the goal is will help you with investing uh, with the horizon of meaning the time that you need to invest for. And it also will help you understand the risk level that you are willing to take. And we'll go into that a little bit more. But again, the number one is what's my goal for investing, and that is going to guide you of where you need to invest and for how long. So I also want to talk about the difference between investing and trading, because a lot of us sometimes think about buying and selling. That is considered trading, because trading is when you're doing it short term. Again, where you're buying and selling stocks. I bought X company today. I'm going to let it accrue for a little bit and then I'm going to sell it next week. So that's trading. You focus more on quick profits. If I know a price is 10 and I have a feeling that it's going to go up to 15, you want to take advantage of the profit of the price increase. And the goal is to capture those short-term gains. Investing, it's more like a long-term approach. You focus more on growing over the years, and your goal is to build wealth. So there are things that that differentiate those two aspects of investing. So I definitely wanted to make sure that I included this difference as we go through the presentation, as you know, as we talk about different investment options that you have. And then here I wanted to include investors think in years, traders think in days. And you may think, maybe I want to be both. Maybe you want to be an investor and a trader, and that's completely fine. But again, it depends on what's your goal and what's your in the intention of investing. So again, as we go through the presentation, think about those things. Do I want to invest for long-term wealth, or do I just want to focus on capturing those short-term gains or quick profits that um, that companies may give me in the short term? Any questions between those two, or any comments that anyone has as of now?
No questions so far.
Thank you. Okay. So again, I also want to talk about savings versus investing. And I know we talked about smart savings, and we also talked about different buckets of savings. We talked about emergency fund savings. We talked about more like a midterm savings, things that are going to occur within 3 to 5 years. And then we talked about long-term investing. So when you think about savings, it just means setting money aside in a place or an account that is there safe, that is going to provide resources for short-term needs. Your car broke down, or my hours were reduced, so I need to supplement my income. So those are things that are there to address short-term needs. Investing, again, it's more long-term. It's something that you're trying to accomplish over time. What are those long-term goals that you're trying to reach? So if you're 30 today, I want to retire when I'm 50, when I'm 55, 60. So what are the things that you need to put in place today so you can achieve that long-term goal? And again, some of those differences is saving an emergency fund, things that come up within 3 to 6 months as an emergency, and then investing for retirement, education. Or do you just want to say, I want to be financially independent and have financial freedom by the time I'm 40? So having those, um, again, those goals are really important. Okay, so now we talked about the difference between trading, investing, difference between savings and investing. I wanted to show a graph here that gives us the comparison of what it means to invest, have money in a high yield savings account, because we talked about that, and then having money in a savings account. So this green line right here is the investing. So this line is assuming that you've deposited or you invested $5,000 over 20 years in a fund that gives you a gross 7% a year. So we ended after 20 years with 19,000. We started with 5, we ended in 19,000. And then comparison to a high yield savings account, you started with 5,000 and in 20 years you accumulated 10,000. And then if you have $5,000 in a regular savings and you let it sit there for 20 years, it was basically flat because regular savings are not meant for long-term investing. So I wanted to show this comparison to support the point that different savings buckets and investing buckets have a goal, but also a strategy attached to it. So if you have anything that is for 20 years, letting it sit in a regular savings account is not going to give you any growth. So definitely investing for long term is important, and those high yield savings account are for things just for emergency purposes. So I'm gonna leave this graph here for 2 seconds because the difference is it's it's sizable. And again, this is just for illustration purposes, but it gives you a good idea of what investing $5,000 in a fund that yields 7% annually versus a high yield savings account versus a regular savings account. Okay, so I know some people may be afraid to invest and I just want to leave the money in a savings where it's not losing money. But this slide talks about what I talked about at the beginning, investing to beat inflation. So what's inflation? Inflation is the the basically the price, the cost that reduces the value of your money over time. And on average, an inflation has been 3%. So I'm sure we all know, we all feel the difference between what $100 gave us 10 years ago to what $100 gave us today. So if you had $100 um, 10 years ago to buy a basket of food here, you would have spent $74. 10 years later, you have to spend $100 to buy the same amount of food. So that is what inflation does to you. So if you leave your $100 sitting in an account where it's not accumulating at least over 3% of interest, you're basically losing the purchasing power on that particular dollar. And a source that you can go in and read more about it and also calculate what $100 was 20 years ago to what it is today. You can go to the US Bureau of Labor Statistics and they have a CPI calculator there that you can go in and plug any numbers and look at the difference. So again, having money in a savings account for long term does not give you the risk of losing that particular capital that you've saved, but you face the risk of reducing the purchasing power of those dollars deposited in the savings account, or if you have it under the mattress, or if you have it somewhere um, in your checking account. Any questions, comments about inflation and the losing purchasing power of your dollar? I know this is not something we think about it all the time, but it's something that we face when we go to the grocery store.
No questions at the moment.
Thank you, Jennifer. So again, I'm building the scenario of, okay, do we invest? Do we save? Or if we're not doing anything with the dollars that we have, then what's the risk that we have of losing our purchasing power? Okay, so the next risk that I want to talk about, so inflation risk is one of them. The other risks that you have with investing are the possibility of losing the value of your investment. So if you invest in a company that's doing great today, no one can guarantee that the company is going to be alive next year. So that is the risk that we have when we invest. We run the risk that we may lose part of our investment. The reward is that potentially your money is going to grow. and you may invest in a company that is um, has a $10 today, but then it may grow to 100 in a few years. Like Tesla is a perfect example. Tesla went from a very low price to a price up to, oh, it's up 500 one point or even higher. So um, understanding, but also investing brings risks. But I also want to add here that you can manage the risk. You can minimize the risk. So how do we minimize the risk of potentially losing all of our investment? So the first thing that I want to talk about is diversification, and some of you may have heard this concept. But diversification means that you spread your money in different asset types. So nowadays technology, especially like Meta, Nvidia, and other companies that are tech based, are go up and down. Sometimes, can go up 5%, can go down 5%. But if you diversified your investment into invest in technology, but you also invested in healthcare, and then you invested in utility stocks like the electricity and cable companies. So when you spread your dollars in various asset types, that will minimize the risk of investment deficit or reducing your investment. Another way is that you can allocate different asset allocation. That means that you may have a mix in stocks, you may have a mix in bonds, and then you may have a mix of in cash. And we'll talk about what that means, what stocks, bonds, and cash means. So having a blended portfolio or an account that has a mix of all those may also help you reduce the risk. It's not going to remove it completely, but it will definitely minimize it. Um, and then the risk that you're willing to take will be driven by the time horizon that you have. The longer that you are going to stay invested, the more that you can take on risk because you can write out any markets ups or downs. The market, for example, in 2022, the overall S&P 500, the basically which is the index that holds the biggest 500 companies of the economy, was down 22% in 2022. It was negative 22%. But the 2 years that after that, the market or the S&P 500 yielded about 20 to 19%. So what you lost in 2022 was gained back in 2023 and 24. So any questions or comments in this slide?
Yes, two questions for you.
Mhm.
One was, what is the correct order to get started? Can I start investing and skip having an emergency fund, or should I prioritize investing over paying off debt?
So definitely having an emergency fund is key because if you have an emergency, then if you don't have any money set aside, it will increase your debt. When you increase your debt, you're not paying debt down. The money that you could be putting in an investment, you put in toward debt. So I always like to see it as a phase. One, build your emergency fund. Two, reduce your debt or minimize your debt to a point where you're not spending so much money on a month-to-month basis paying toward debt. And then the third bucket is start investing. So as you reduce your debt, the money that you're saving on those debts, you can put it toward investing. So I hope that answers your question. But if you want me to clarify a little bit more, please let me know.
Thank you. And another question was, can you invest in stocks in utility or utility stocks essentially? Can you invest?
Yes, you can. Yes. And I'm going to talk about a little bit more about stocks and then owning different asset classes.
And one more, how
Mhm.
would you recommend assessing risk and investing when the global economy seems very volatile?
Great question. So there are different options. international stocks, there's national stocks. You can invest in the US economy, you can invest in a blended US economy and then international economy. So you can build a diversified portfolio that gives you exposure to the US economy and it gives you exposure to certain aspects of the international economy. You can focus in Asia, you can focus in and the other continent. So there are different ways to diversify it. And going through the study the trend that different economies are showing and then building a portfolio based on that will give you less exposure to the global economy and especially during the times where it's not as stable.
Thank you. That's all the questions for now.
Awesome. Okay, so I want to talk about diversification and hopefully that answers some of the questions that the people have. So again, diversification means spreading your money across different types of investments. So does it and not putting your eggs all in one basket. So I like to use that analogy. So one fund or one portfolio that holds only stocks, it's not well diversified. Again, it's okay to have a portfolio with only stocks, but know that the risk is higher than having a portfolio where it's diversified with different assets. If you have only stocks and bonds and some cash, so the reason why this is not well diversified because this has large stocks. So stocks are broken down in different sizes. So we're not going to go into today's webinar because it's for times purposes, but stocks are value or large growth stocks. So basically small companies versus big companies or companies that are starting out versus companies that are already established. Companies that are already established are more stable and are not facing a risk of closing the doors tomorrow. Companies that are just starting have a higher risk of not working out or maybe not being in existence in next year or in 2 years from now. So you definitely want to diversify, even if you're investing within stocks, you want to diversify in having small companies and also having well-established companies. So this last one is more like a well-diversified portfolio where you have stocks, where you have large stocks, you have small stocks, basically big companies and small company. Bonds are, you have government bonds and then you have corporate bonds. And then we'll talk about again what bonds are. And then you have some cash set aside where in case I need to take some cash out of my portfolio right away because I need access to cash. Basically, you want some liquidity available, and that without having having the need to sell stocks or the bonds that you have invested. Okay, so how do you approach risk? So there are three investment philosophy that we talk about when we are looking at investing. And basically, your investment philosophy is different for everyone. It's your general attitude toward risk and return. So if you're a conservative investor, one that has the philosophy, I'm okay, I just want low risk, and that's going to give you a low return. Or if you're someone to say, you know what, I want to balance the risk and the return so I can have a little higher return than just being a conservative investor. Or you could be someone to say, I'm aggressive, I love taking risk, I want the potential of higher return, so I'm okay weathering any downturn that the stock will have. And so look at it in two different ways. If you're someone that is in younger, that has more time to invest and weather the storm, then you have the capacity to be more of a risky investor. You may also tolerate more emotional volatility and you're okay going up and down. But if you're someone that's closer to retirement, you may be someone that is willing to take risks, but you may be someone that does not have the capacity to take the risk. Because if you are in your 60 and you're trying to retire in 2 years, even though you could be a risk investor, you have to think about, do I have the capacity to take on the risk if I'm going to retire in 2 years? So that's two different ways of looking at your investment philosophy, your risk tolerance, but also your risk capacity. So I've had clients that I worked with that have a high risk tolerance but the risk capacity is low because they're close to retirement or close to achieving the goal that they have. So think about what's your investment philosophy, and there are surveys that you can have access to where you take you complete a questionnaire, and then at the end we'll give you a number and it will tell you you're someone that's willing to take risk, you're an aggressive investor, or you're someone that it's a moderate, or you'd rather be a conservative investor. Okay, the next slide. This is an investment pyramid. This gives you a good indication of which assets, which investments are low risk there versus higher risk, and which ones give you a lower return versus a higher return, and which ones are more short-term oriented versus long-term oriented. Again, you can be someone that is investing in bonds long-term, but just know that it's going to give you a lower return. So in this pyramid, at the bottom is from lower risk, lower return, to, as it goes up, from higher return, higher risk. Your lowest risk related assets or investments are what's called cash and cash equivalents. Those are your checking accounts, savings account, cash deposits, or a money market also. The second level, second tier are your bonds. And there are types of government bonds, there are corporate bonds, and then there are ETFs that are bonds. And again, I'm going to go over into what each one of them means in a little bit. But it's basically the variety of different bonds that you have that you can invest. Some give you a higher interest rate, and some give you a lower interest rate because there are risks associated with bonds as well. And then the third tier are your equities and real estate. Equities are stocks. Equity means that you're part owner of a particular company. So if you purchase stocks, that gives you equity on that particular company. So you're part owner of the company. And then you can have buildings, physical properties to invest. And then the last tier, the fourth tier, is what's called commodities. They're precious metals like gold and silver, things like cryptocurrencies. They're not basically companies that grow in value, or they have people working for them, or that have services or products that they sell. The more what's called their price and value are more like a speculation. They're based on demand and also quantity. So a lot of young investors that want to invest in cryptocurrencies, that's the highest risk of investing that you can do. But if you're in a younger side, again, you can weather the ups and downs because you have a longer time to invest. I know this graph shows that, a good, again, a lot of information here. Any questions, comments, or any points of clarification that you want me to make?
No questions so far. Someone said they love the graphics.
Awesome. Yeah, the graphic paints the picture and makes the comparison really well. Okay, so now I want to go drill down a little bit of what each asset class, at least the most common ones, represent, or what they mean. So stocks are, like I said, they're gives you ownership in a particular company. So if you buy stocks of Tesla, for example, you hold shares of Tesla. So you are a part owner, you hold shares. when the company grows and their profits are higher, you also take advantage, or you also earn profits with the company. The stock that you hold grows in value, meaning the market value of your stock is higher. Therefore, you can sell it for a higher price when you're ready to sell, and increases your bottom line, helps you grow your wealth. Stocks are good for long-term investors seeking growth. Again, stocks are really tied to companies. Companies have good years, companies have bad years, companies face challenges. So that's why you definitely, when you invest in a company, you want to be a long-term investor to give enough time to that particular company to increase their profit or to adjust based on the economy. And also stocks are more comfortable, are good for people that are more comfortable with the short-term ups and downs. Again, you have companies like the Apple do really well one year, and then another year there no one wanted to buy their iPhone, so they didn't do as well, but then they recuperated and then their profits were higher the following year. So another example is the Apple or Disney stock that, you can see a year or a few months that are really doing well, then there's some months that are not doing as well. But just give it time for the company to recuperate and adjust its profits. All public companies have to disclose their financials to the Security Exchange Commission. So any big changes that they need to report, they have to report quarterly. They also have to do an annual reporting. And then you can always see if the company has any major changes, like the CEO. There are other things that's happening with the company that may help you make a decision whether you want to stay with the company or you just want to sell your shares and go somewhere else. So you have that option. And then bonds, on the other hand, are a loan that you give to the government, for example. There are different types of, as I mentioned, bonds. One of them is a government bond. A government bond is when you buy you lend the government, for example, $1,000 for 10 years. It will have what's called a maturity date, or the date that the bond ends. It's in 10 years. You receive 5% interest on that $1,000. So you basically receive $50 a year. After 10 years, you will receive the principal back, meaning the $1,000 that you put down, plus the interest that you have accumulated over the years. So you've earned in 10 years, $500 on the $1,000 of that particular bond. There are also other bonds, such as corporate bonds, meaning you may have private companies or public companies that want to grow their services, or they want to improve their products. So they may offer bonds to investors. So let's use the example of Apple, for example. Apple would like to expand their products to beyond iPhone, for example. So they're putting a bond to the public, and then you lend Apple money so they can improve their products or expand their product line. And then after the maturity date, let's say, after 3 or 5 years or 10 years, then you receive the money that you've lent Apple plus the interest that you've accumulated over the years. So again, bonds are less risky because you receive your principal back, and then you get paid on the interest that you are lending the government or a private entity. So this graph gives you a comparison of the stocks versus bonds. So the stock is again, you invest in the future of the company, and as a bond, you are investing basically in lending money to a particular company or the government. The obligation for the stock, they're not obligated to give you any money. You take advantage of the profits that they make as a company. But if you invest in bonds, the obligation is for the issuer, or the one that's giving you the bond offer, to pay you back the principal and any interest associated with that. Again, there's other types of bond that are have like a risk of defaulting, but those are, again, those are, we're talking about just safer bonds like government bonds or high quality corporate bonds that give you the principal back and interest. So again, we're not going to go into details how many bonds are there, but you definitely want to invest in bonds that have a high investment grade or that are established and safe to invest. And investing in government bonds are safe because it's backed by the faith of the United States government. The
Question.
potential, go ahead, yes.
Sorry to interrupt. Just a
Yeah,
question. There's no compound interest in regards to bonds?
no, no. You get paid in the principal that you've put down. Great question.
That's it.
Okay. Yeah, thank you for the question. I think that's a great point of clarification. Um, the potential benefits of a stock, you generate income via the growth of the company, or if the company has a lot of profit in a particular year and then they pay dividends, meaning that they share their profits via a dividend payment with their investors or their shareholders. And then the benefit of a bond is that gives you fixed income and regular interest payments. The risk for bonds are higher, as I said earlier, and then the risk for bonds are lower. So that's why having a portfolio where you have both, you're balancing the high risk versus a lower risk. Bonds trade. You can buy and sell it easily. Bonds are less liquid. There isn't a market where you can go sell your bond to another investor. So you basically either take your money out before maturity date or you wait till maturity date or that date where your bond expires. And then the volatility of stocks every day, they're going up and down, and bonds are more stable. You buy at a fixed dollar and you receive interest on a regular basis. Okay, so now I want to talk, we talked about bonds, we talked about stocks. So now I want to talk about ETFs. And again, we're going back to this pyramid here where we're talking about different assets to invest. So we talked about bonds and what they are. So now we're going to talk about, we talked about stocks. So now I want to talk about ETFs and mutual funds, which is probably something that you hear all the time if you're listening to um, the news about the stock market. So ETFs are exchange traded funds. What is that? It's basically a collection or what's called a basket of investments. So ETF often can include a blend of stocks and a blend of bonds and a blend of other things. You buy one single fund, which is the ETF, one price, and that ETF may hold different uh, stocks or bonds underneath. And I'll show you a little bit what that means. And it offers instant diversification, meaning you don't have to be the one responsible picking the stocks and the bonds to put in your portfolio. There's just one single basket, one single fund that have a basket with different investments. So this is basically a picture of what ETF is. So this one, for example, is a Vanguard fund. And again, I'm just using this for illustration purposes only. Do not take this picture as one to invest in a Vanguard fund. I'm just showing you what an ETF is and how is it made up. So this one you can hold the S&P 500 ETF as a one fund. It tells you here what the dividend payment is, and it can show you what the 5-year return on this particular fund is. So as you can see, you may have ups, you may have down, and then you went up. If you were an investor, for example, that held this fund and then all of a sudden it went down and you sold this fund, you will not have had the advantage to take advantage of the upswing. afterwards. So that's why long-term investing, it's important because you can weather the downs, but you can also take advantage of the ups. So you hold the S&P 500, the S&P 500 ETF. Under this ETF, within this ETF, you hold 8% of Nvidia, 7% of Microsoft, 5% of Apple, and then 3% of Meta, and so forth. So you may have ETFs that are geared more toward technology and finances, like banks, or you may have ETFs that are geared more toward healthcare. So there are different types of ETF, and particularly when if you go read the ETF or the fund before you invest, it would tell you what the investment strategy of that particular fund is. So that's option number one. Or option number two, you can just buy the stocks yourself. You can say, you know what, I'm going to invest 6% in Apple. I'm going to invest 4% in Meta, and you can do those individual buys and sells yourself. So those are the two options. Hold the ETF and have all of those underlying investments within the ETF, or you can pick and choose single stocks yourself. Questions, comments, points of clarification?
None at the moment.
Okay. So then the next one is mutual fund. So I don't have a graph for mutual fund, but mutual fund will basically be the same concept. You hold the mutual fund, and inside the mutual fund, you will have different stocks or bonds within that mutual fund. Okay. So mutual funds are usually more professionally managed, and they have fund managers that buy and sell on your behalf. They are considered more active management, and is usually a little bit more costly than an ETF. ETFs are more of a passive investment, meaning that they don't have an active manager buying and selling every day. But at least it's you hold a portion of the fund without having to own the individual stock directly.
Question, are the ETFs with Vanguard, Fidelity, or Schwab?
All of the
Or-
above. Yes,
oh, okay. All of the above.
yes,
Okay.
yes. So you can have ETFs, yeah, offered by all of those companies that were mentioned and others. Most investment firms have offer ETFs and mutual funds. Any other questions?
No, not at the moment. Thank you.
Thank you. Okay, so this graph gives you a nice comparison of a mutual fund and an exchange traded fund or an ETF. So mutual funds are older than ETFs. ETFs have not been around as long as mutual funds have been. And I think it was I don't know if it was I don't remember if it was State Street or Schwab. Don't take me on that. Don't quote me on that. One of those big companies offer ETFs for the first time for investors that did not have those big assets to invest. It's more for investors that are more average investors that want to invest at a lower cost without having the need to pay high fees for actively managed funds. So it's a good lower cost option for regular investors to invest in a basket of investment. Um, so the big differences is that mutual funds, you buy partial or whole shares. And in an ETF, you buy whole shares. So if you buy $100 and that gives you 3.5 of shares, you only buy 3 shares. So versus the mutual fund, you can buy the 3.5 shares. The share price for a mutual fund is only calculated at the end of the day. You're not going to see a mutual fund price fluctuate during the day like an ETF. An ETF, you may see the price 50 right now, 5 minutes later, you will see a 50.5. So that fluctuates throughout the day. So if you buy a mutual fund, you will not know the price that you purchased a mutual fund at until the end of the day. That's when you'll see the price. Um, the trading bought and sold through the fund company, and then traded on exchanges throughout the day. So meaning you can buy it through the S&P 500, the NASDAQ, So it's traded more through the fund company that holds that mutual fund. Fees for a mutual fund are often higher than ETFs. Again, ETFs offer you options for a smaller fee, which is good for those that are doing the trading yourselves instead of having an investment manager do the active buying and selling of the mutual fund. ETFs are more passive. I also want to mention before we move on from different asset types about target date funds. Target date funds are the same. You can have a ETF that is a target date fund, and then you can have a mutual fund that is a target date fund. Target date funds are funds designed for a target date, for a retirement date, for example. So if you are someone that is looking to retire in 30 years, you can buy a target date fund 2055, and the investment manager that holds and manages that target date fund is going to do the allocation for you. So if you are in 2025, your allocation is going to be aggressive because you have 30 years to basically take your money out of this fund. As you get closer to 2025, the investment manager of this fund is going to reallocate the investment to be less risky, more of a moderate and conservative blend, because you are going to take your money out soon. So they want to protect the capital that you already have invested in that particular fund. So it's an option for those that don't want to worry about how much do I need to put in stocks, how much do I need to put in bonds. The fund company will do that for the shareholders of those particular funds. Again, we already talked about any questions before I move on from this.
No.
Okay, so now we talked about stocks, we talked about bonds, we talked about mutual funds, we talked about ETFs, we talked about target date funds. And then, so now those are the different investment options that you have. So now I want to talk about, remind everyone the accounts that we talked about last week. And understanding your goal, but also understanding which account goes with those particular goals are also as important. So if you are working toward retirement, definitely you want a 401k if you have access to one, because as we talked about last week, your employer can match those contributions. If you don't have access to a 401k, but you also have the ability to have an IRA on top of the 401k, then you can have a traditional IRA or a Roth. And this is going to depend on whether you want to pay taxes now or you want to pay taxes later. And then a brokerage account. I don't think we talked about this as much last week. A brokerage account is basically an investment account that you open with a broker. Fidelity is one of them. You can open a brokerage account with Vanguard. You can open a brokerage account with Betterment is another custodian bank. And so there are different providers where you can open a brokerage account. It means just an investment account where you can make contributions yourself. You can transfer money out of your bank account and put money in a brokerage account, and you can withdraw at any time, and there aren't any limits as to how much you can put in a brokerage account. You may have brokers or companies that have minimum investment. So definitely before you invest with a particular account, that make sure that you pay attention to any investment limits. You may have brokers that have a limit of 25,000 or a limit of 1,000. So definitely understanding that it's important. And these are mainly for general investing to build wealth outside a retirement account. And this will be an option. Let's say you want to buy an investment property in 10 years and you want to start building and accumulating some funds now. For 10 years, you can have access to those funds. You can have a brokerage account and invest outside of the retirement account.
Question here.
Mhm.
Is an annuity account considered an investment?
Yes. So annuities is a different type of investment option. And it an annuity is a contract. You basically buy a contract that is going to give you equal payments, monthly or lump sum by the time you end that contract. But that is a different type of investment. Yes.
Okay, that is it.
Thank you. Okay. So this summary of all the asset types, at least the most common ones. So again, this is just kind of like the beginning stages of investing. So the most common asset types are the stocks, which give you long-term growth, bonds, which gives you steady income, ETFs, which allows you to diversify and are lower cost funds, mutual funds gives you the diversification, but they're professionally managed. And because of that, they have a little bit of a higher cost. And then those target date funds, it allows the fund to auto adjust as your retirement option um, nears that particular year. Each investment type plays a role. So the key is choosing the right mix. So again, if you are a short-term investor, understanding the risk, understanding how much to have in bonds so you can have the money available so when you need it. But if you have a long-term goal of retirement, for example, or in 20 years, I need the money, then understanding the mix is also important. Um, some matching strategies for your goals. I wanted to provide this. It's so if you have a goal for short-term goals from 1 to 3 years, your focus is having your money safe in a low-risk asset, such as a bond or a high-yield savings account or a money market fund. Those do not fluctuate in price, and it gives you a steady um, um, income and interest payments. If you have more like 3 to 5 years, having more of a balanced mix, I'm going to have maybe 80% in stocks and 20% in bonds, or you can have an ETF where it's giving you a nice blend of different stocks. Um, so a good starting fund will be having like 80% in stocks and 20% in bonds. Um, and then long term, if you have more than 10 years, 20 years, or 30 years, your blend is going to be more in stocks rather than bonds. Um, and if your investment goal is to increase your capital or grow the money that you have invested, then build wealth over time, then you want to focus more in those stocks or the ETFs that hold those stocks that give you the growth that you want. If your goal is just to have income or additional cash flow, then you can buy ETFs or mutual funds that give you a dividend payment, or stocks that give you a dividend payment, or regular interest income that you can use if you want to, or any particular year. You may have an ETF that pays annual dividend, so you can wait for the annual dividend to be paid, and then you can to use that dividend to either buy more shares or just to take it out as cash.
I have a question.
Questions? Yes.
Can you have different goals at the same time, or should we start short term and move forward?
Yeah, no, you can have different goals at the same time. Understanding where your cash flow is on a monthly basis will help you answer that question. So, for example, if you have enough cash flow where you're like, I'm investing in my retirement, I'm also building my emergency fund, then that's completely fine. So yeah, that the answer is yes, but it's all depending. Okay, how you want to put to work your cash flow, and that's how I will answer that question. But definitely, if you have the cash flow on a monthly basis to have multiple goals, you can definitely do that.
That's it for now.
Awesome. I love the questions. Okay, so Okay, I've shared all this information. We learned about investment accounts, investment assets, and risk and returns, and ETFs, and stocks and bonds. So now, what do you do now? So I wanted to offer some steps that you can take if that's something that you want to do next. Again, if you have a specific question or a point of clarification specific to your need or your goals, you can always schedule a one-on-one with me and we can talk about a specific situation. So again, this is more like a general view for if you want to take some steps of how do you move forward. So the first one is choose where to open an account. So again, I want to disclose that I don't have any ties with Fidelity and Schwab. They're mainly the most well-known, biggest names that you probably see on TV and that you've heard through your employer. So by no means I'm highlighting these two companies because there's some kind of benefit or they're better than others. No, they just well-known names. Um, you can there, for example, Fidelity has options for uh, people that want to do it themselves. You can open um, an account. So if you want to open an IRA, you can open a Roth IRA or traditionally dependent on how you want to invest. You can open a brokerage account through Fidelity. You can open a 529 through Fidelity and for college savings. So again, understand what your goals are and what type of saving or investing are you trying to do, and then that's going to drive the type of account that you're going to open. You cannot open a 401k because that's only employer sponsor. Only employers can do that, and they'll offer that through your employment agreement. Know your investment goal. Am I investing short term? Am I investing for 5 years? Am I investing for 10 or 20 years? Again, that's going to determine how you're going to invest and which funds you're going to invest in. And then once you open the account, you know your investment goal, which means the type of account that you're going to open. Then you're going to transfer funds. You're going to link your checking account or your savings account to the account of Fidelity, for example. And then you're going to transfer the amount of funds that you want to invest. You can transfer a lump sum, meaning you can transfer like $500, or you can do monthly transfer and invest every month in that particular fund. It doesn't have to be all at once. You can invest once a month, you can invest once a week, you can invest every 2 weeks. So the the timing that you invest in, it's there's no limit. And then once you transfer the funds and they're there in the account, you can select the investment funds that you want to invest. So let's use the example of the Vanguard ETF. Once you have the $500 in the account, you can go in, select the Vanguard ETF and do trade. And then say, I want to buy $500 of Vanguard ETF. And then the custodian bank or Fidelity will take that order, will go to the market and buy the shares for that fund, and then you should see that those shares purchased in your account the next day, and they settle in 2 days. Any questions on that flow of what I just explained?
Not at the moment.
So again, those are the steps that you can take. And then key takeaway, you don't have to be wealthy to start investing. There are a lot of options that you can start investing with, $50, $25. Investing helps your money work for you, and time and consistency is what matter, and not just this dollar amount. And time in the market is it's a risk, so just stay consistent and give your money time to grow, and start where you are, use what you have, and stay consistent. So I want to thank everyone for your attention and for your comments and your questions. Any last minute questions or comments?
Just a lot of thank yous, some thank yous. I'm sure we will have a little bit of a closing moment right now, but if you have any last minute questions, feel free to drop them. Otherwise, just a good bunch of thank yous, and that was great information. And let me close it up by providing a few more resources for you all. Starting with, if you can all see my screen, um, starting with next week. So if you are joining us here for the first time today, you are in week 5 of our 10 weeks of Worth and Wealth financial education webinars. And if you missed the other weeks, don't worry about it. They're not consecutive. You don't need to know what we learned last week to be here this week. But you do have more time and opportunity to join us for the next 5 weeks. Next week, our topic is side hustles and wealth building. Same time, same place. And if you can't make it, definitely sign up and register, and you'll receive the slides and recording for that as well. Also, as Samantha mentioned, you are able to get 1 free hour of financial coaching with Samantha, who you fabulously see here and who did an amazing job today. And that is at no commitment and completely confidential between you and the coach, in this case, Amanda. We don't have any information about who does coaching, when, where, what. We just know that you did it and if it was good and you had a great time. So we definitely recommend that everybody takes advantage of this opportunity. And lastly, we have our financial education platform, Enrich, where you're able to find articles, videos, mini courses on topics from saving, budgeting, and definitely investing. So we always recommend that people check that out as well. So that is it. We are over time, and I will say goodbye. Thank you everyone for joining us today. Bye.